So we'll be now discussing the particular chapter, prospective financial information and other assurance services. And as a part of this particular chapter, we are going to talk about the standards which fall under the series of SAE, Standards on Assurance Engagement. So in the chapter prospective financial information and other assurance services, we are going to talk about the standards, the professional standards which are falling under the category of SAE, standards on assurance engagement. We are going to discuss. So what are these standards on assurance engagement? And in fact, let me tell you well in advance, in this particular chapter, we are going to cover three standards under SAE series. We have something called SAE 3400, SAE 3402, and we have SAE 3420. So there are three standards which are required to be covered as a part of this particular chapter. So let me take you to that particular content of the chapter. Yes. Yeah, here you see. So we have in this chapter to cover three standards: SAE 3400, SAE 3402, and SAE 3420. So these are the three standards which is going to make up this entire chapter, prospective financial information and other assurance services. But before we actually go into that technical standards and all, let us try to have a background discussion. What are these standards are all about? So once again, I'm going to revise whatever I have discussed in the earlier chapter. So as I have told that ICAI has created a board, Auditing and Assurance Standards Board, and this Auditing and Assurance Standards Board, for the purpose of providing guidance on auditing and related matters, they have given various kinds of standards. So what are the different kinds of standards which are given by AASB under the guidance of ICAI? So we have something called SA, we have something called SRE, we have something called SRS, and we have something called SAE. So SAs, that is standards on auditing, they become applicable whenever you are conducting audit of historical financial information. So as a chartered accountant, when you are called upon by some client to do the audit of their historical financial information, then you have to follow the guidance which has been given under standards on audit. Then we have SRE. As a chartered accountant, if you are called upon by any client to conduct a review of historical financial information, sometime being a practicing chartered accountant, the organizations might call you to conduct a review of historical financial information, then you are required to follow the guidance given under SRE. And in the review of financial information chapter, I have already explained you the difference between audit and review engagement. Audit is a reasonable assurance engagement, whereas review is a limited assurance engagement. In audit, we perform more in-depth audit procedures, whereas in review engagements, we perform very limited audit procedures. In fact, we will do only inquiry along with analytical procedures. So all that discussion, we have already had it in the chapter standards on review engagement. Then we have something called standards on related services. This discussion we had in the chapter related services. So sometimes, being a practicing chartered accountant, you will not always do only verification work. You will also try to perform agreed upon procedures. Sometimes a client will call you to perform agreed upon procedures. And also sometimes a client will call you to do the compilation engagements, compilation of financial information. So as a chartered accountant, if you are called upon by client to perform any of agreed upon procedures or compilation of financial information, then those services will be called under related services. And how to do that related services? And in case if you accepted any engagement which involves these kind of related services, then you are required to follow standards on related services. Then we have the last category of the standard, SAE. Sir, what are this SAE? So ICAI says SAE will become applicable when you are associated with, when you are involved in verification of other than historical financial information. In case, as a chartered accountant in practice, if you are called upon by some client to do some engagement which has nothing to do with the historical financial information, you are trying to do some work, a client has come to you, a client has approached you, offered you to do some work, but in that work you are not working upon, your subject matter is not the historical financial information. So if you are called upon by any client to do some which does not involve any historical financial information, then assurance SAs will become applicable. Sir, you are telling other than historical financial information, that means what it will get included? Other than historical financial information means it could be non-financial information. It could be non-financial information, or it could be future financial information. It could be what? Future financial information. When I say other than historical financial information, it could be future financial information, or it could be non-financial information altogether. So sometimes as a chartered accountant in practice, you will be called upon by some clients to conduct some engagements which does not have anything to do with the historical financial information. That means either as a chartered accountant in practice, you are required to do some work which is related with the future financial information, or you might be required to do some work related to other than financial information. Some non-financial information you might be required to work upon. So those engagements, we broadly call them as assurance engagements. And whenever you are doing such engagements, which standards will become applicable? SAE, standards on assurance engagements, will become applicable. So if you see the title of the chapter, as I've told, what is the title of the chapter which we are going to talk about now? Prospective financial information. What do you mean by prospective financial information? Prospective financial information means nothing but future financial information only. So as a chartered accountant in practice, if you are called upon to conduct any assignment which involves a future financial information, how to do that engagement, and also other assurance services, any other assurance services which does not involve any historical financial information, how to do that engagements, that guidance has been given under this particular chapter. And as I've told, in this category of SAE, only 3 standards are issued. That 3 standards we are going to discuss now. So what are the 3 standards which are given? So the 3 standards which are given are SAE 3400, SAE 3402, and SAE 3420. So we'll trying to take up each and every standard and try to understand in a detailed manner. So if you see here, SAE 3400 is going to talk about examination of prospective financial information. In case as a client, in case if your client calls upon to verify the future financial information, then what you are supposed to do, how you are supposed to do that engagement, that guidance has been given under 3400. Assurance reports on controls at the service organization. Is something sounding familiar? Controls at a service organization, is something sounding familiar? It should. Why? Because immediately, just in the immediate previous class, we have understood SA 402, and if you pay attention here, the numbering is SAE 3402. So 3402, SA 402, both are actually related. That's why the numbering SAE 3402. So we understood a concept of user entity, service organization, user auditor, service auditor, verify, report on internal controls, and all some concept we have discussed it, right? So sometimes as a chartered accountant, you might be called upon to report on internal controls of the service organization. Sometimes a entity might approach you to conduct verification of only internal controls and give a report on only internal controls. So when you are giving a report only on internal controls, that is other than financial information, that is a non-financial information. So how you can verify the internal controls and give a report on that internal controls? That guidance has been given under SAE 3402. First of all, why this is coming under assurance services? Why? Because it is a work related to non-financial information. Whereas SAE 3400, it is a financial information only, but it is a future financial information. So we'll talk about it in a detailed manner. When I take up SAE 3402, I will explain to you once again in a detailed manner what exactly is the nature of this engagement. Similarly, we have one more standard, SAE 3420, which is going to talk about assurance engagements to report on the compilation of pro forma financial information included in a prospectus. So here also it is something related to future adjusted financial information. When I say pro forma financial information, it means future adjusted financial information, something which is similar to future financial information only. So sometimes when the company is releasing the prospectus, when the company is going to issue the shares, or when the company is going to acquire another entity, so they might prepare their financial statements considering some future events in mind. So that we call it as a pro forma financial information. So what is that pro forma financial information, and how we will review when that pro forma financial information will be prepared? All that discussion we'll try to have when we take up that particular standard. But here also, this is one such engagement which is relating to future financial information. When I say pro forma financial information, that is also something talking about the future only. So since it is a future financial information, this also will fall under that SAE category, and regarding that, SAE 3420 will give the guidance. Regarding that, which standard will give you the guidance? SAE 3420 is going to give you the guidance. So like this, under SAE series, we have 3 standards which are required to be covered: SAE 3400, 3402, and 3420. So we'll try to pick up each standard now, and we'll try to understand in a detailed manner. Clear? So shall we start? Shall we go ahead and take up one standard for our discussion? Yes. Which standard we will take up for our discussion? We are going to take up SAE 3400 for our discussion first. which is talking about the examination of prospective financial information, which is about prospective financial information. So let us try to first understand. So this standard is basically about if as a chartered accountant in practice, you are called upon by client to verify their future financial information and give an opinion on that future financial information, then SAE 3400 will become applicable. But for that, we need to understand what is prospective financial information. What is prospective financial information? Let us try to understand that. We'll take it up slowly. Important chapter. This is an important chapter. Compulsory a question come from this chapter. So listen carefully. But once again, I'm telling you, very easy, very conceptual, also very easy, also very interesting standard. Also listen carefully. You will enjoy the standards. So let us try to understand first what is prospective financial information. So we know what is historical financial information. What do you mean by historical financial information? Historical, something which has already taken place in the past. So in audit, what we do, in the audit, what we are going to do is we are going to verify the financial information which has already taken place. For example, if I have been appointed as an auditor for the financial year 23-24, what I will do, I'm talking about audit. I will come to that prospective information later. So I'm talking about audit. If I have been appointed as auditor for the financial year 23-24, what I will do, whatever transactions which have taken place, which have already taken place for the financial year 23-24, whatever entries which are already recorded in the books of accounts, whatever financial statements which are already prepared by the management. So this past data, this is not something which is about to happen. This is something which has already taken place. The transactions, whatever have already been taken place, the entries which are already been recorded in the books of accounts, the financial statements which are already prepared by the management. So those financial information I am going to verify, and on that I am going to express my opinion whether these financial statements give a true and fair view or not. That's what I do in the audit, right? But sometimes what will happen is some kind of entities, they will not prepare historical, they will prepare historical financial information, but in addition to that, because of some special circumstances, they might be required to project their information for the future. They might be required to prepare their projections for the future. Sometimes some kind of entities, because of some requirements, that could be because of legal and regulatory requirements, that could be because of some special circumstances, that could be because of need for loan, that could be because of raising the money. So whatever may be the reason, in some special circumstances, some entities are required to estimate their future financial information. Also they have to estimate how much amount of future sales they will be making, how much future profits they will be making, what will be their future assets, what will be their future liabilities. So these kind of things, sometimes entities are required to estimate. See, here it is an estimate actually. Why? Because we don't know. So the managements, the clients are going to make some assumptions about the future, and they prepare, they forecast the future, and they will try to estimate their future financial information. What will be their future profits? What will be their future sales? What will be their future assets? What will be their future liabilities? What will be their future profit and loss statement looking like? What will be their future balance sheet looking like? So they will estimate the future and prepare the financial information. Sir, why that requirement arises? Why basically entities might be required to prepare the future financial information? I will give you a few examples. Might be listed companies are there. So listed companies, what they will do is they will give estimates, they will give targets. You might have often heard in the news, if you're following the business news and all, you might have often released, for example, if Infosys company has released their results, so there will be news channel telling the Infosys profits are lower than what has been expected. Infosys profits are lower than whatever has been expected, whatever target has been given. Below that, Infosys has declared the profits. Or sometimes you will say Reliance Industries Limited has exceeded the targets. So basically, in the case of listed companies, what managements will do is, on the basis of their past data, on the basis of their current trend, on the basis of historical information, they will estimate, they will do the best estimate and give, okay, last year we have made 80 crores of profit. In the next year, we might make 100 crores of profit. So like that, what listed companies will do is, for the purpose of the market research, for the purpose of their market analysis, the listed companies might prepare the future financial information. They will give targets to the industry. This year we are going to achieve this much amount. So that could be one reason why entities might prepare the future financial information. Or there could also be a reason, for example, there is some company, that company wants a loan from the bank. That company needs a loan from the bank. Now they went to the banker, they told, boss, we need a loan. We are doing the business, we need some amount of loan. They went to the banker and asked. Now the banker is telling, okay, boss, I will give you the loan. Whatever loan you want, I will give you. But I want one favor. What I want one favor is you have to prepare the projections for the future. You have to prepare projections. You bring to me the projections. So the banker will ask, often you might have heard it also. If you're working in an audit firm already, you might have heard about these kind of things, of projections. The banker will say, okay, you do one thing, bring the projections, that to those projections which are verified by a chartered accountant in practice. So here also the companies might be required to prepare for the coming 5 years, for the coming 10 years. They might be required to estimate how their future sales, how their future profits, how their future assets, how their future liabilities will look like, and they will prepare that prospective financial information and they will get it verified by a chartered accountant. Then they will go and give it to the banker. If the banker is satisfied about that future financial position, then the banker will give the loan. So here, this also could be one reason why the entities might be preparing the prospective financial information. So one example I have told, for the market purposes, listed companies might prepare the targets and publish it. And also the companies, in the case of requirement of a loan from the banker, then also they might be required to prepare prospective financial information and they might ask a chartered accountant in practice to verify it. So like this, I told you only 2 examples. There could be numerous reasons. There could be various circumstances. There could be various requirements because of which entities might be required to prepare the prospective financial statements. And this prospective information can be divided into 2 categories. Prospective financial information will be of 2 types. What are the 2 types of prospective information? Let us try to understand it first. See, take for example, I will give you one data. So year 1, I'm conducting some management of the entity. Like for example, Reliance Industries Limited, they have a track record of their profits. Year 1, they have, in the first year, they have made a profits of 100 crore. In the year 2, they have made a profits of 120 crores. In the year 3, they have made a profits of 140 crore. And in the year 4, they have made a profits of 160 crores. So this is what the trend of the company for the past few years. Now what the management has done is, on the basis of their past data, they have estimated in the next year, in the year 5, the profit will be around 180 crore rupees. What the management has done, on the basis of their past data, on the basis of the last few years of data, in year 1, last 4 years of data they have analyzed, they have read the profits of the company. So on the basis of that, on the basis of the past data, they have projected, they have estimated that their profits are going to be, their profit for the year 5, their profit for the coming year, it is going to be 180 crores. So this we call it as best estimate. This we call it as what? Best estimate. So what do you mean by best estimate? Best estimate means which is most likely to happen. So take for example, since if I am reading the past few years of the profit trend, it is clearly visible that in the year 5, the entity is going to make 180 crores of profit. That is an estimate, but that is going to be a best estimate. Why? Because it is highly achievable. It is what? Highly achievable. This kind of prospective financial information, we are going to call it as forecast. This kind of prospective financial information, we are going to call it as what? Forecast. Now I will tell you another story. I will tell you another kind of projection. So another kind of prospective financial information. Take for example, there's a company, Reliance Industries Limited. It went to the SBI. And they told, sir, we need a loan. We need a loan of 1,000 crore. So SBI told, okay, boss, you prepare the projection for the coming 5 years. Now what the Reliance Industries Limited has done is, they have told, okay, in case if you give us this loan, of 1,000 crore rupees, we will invest in the plant and machinery. Then our sales in the coming 5 years, it will go to 10,000 crores. Year 1, it will be 10,000 crores. Year 2, it will be 15,000 crores. Year 3, it will be, coming years I'm talking about, future years I'm talking about. So in the coming year 3, it will be 20,000 crores. So if you give us the loan, we will go and invest it in the plant and machinery. Because of that investment, we will make 10,000 crores of profits in the year 1. We will make 15,000 crores of revenue in the year 2. We will make year 3 20,000 crores. So this kind of projection they have prepared. You tell me, is it a best estimate? Is it a best estimate? No. Why? Because here we are not doing the estimate on the basis of the past data. These are all, we call them as hypothetical assumptions. These are all called as what? Hypothetical assumptions. These assumptions, whatever assumptions which has been given, whatever prospective financial information which has been presented here, that could happen, that might not happen. So here basically they are trying to say, Reliance is trying to say, if you give us a loan, then we could achieve this. That means if the bank is not giving a loan, they might not achieve it. So it is completely an hypothetical assumption. It is not based on any past data. It is just a hypothetical assumption. So these kind of prospective financial information, we are going to call them as projections. We are going to call them as projections, so which are completely hypothetical, which we can't say they are more likely to happen. They might happen, they might not happen. Whereas if you look at the first case, it is a best estimate. Why? Because we have estimated on the basis of the historical data. We have some basis for that, we call it as best estimate. And the prospective financial information, which is prepared on the basis of best estimate, we call it as a forecast. Whereas the prospective financial information, which is prepared purely on the basis of hypothetical assumption, which might happen, which might not happen. Or if I give you one more example for prospective financial information, take for example, Reliance Industries Limited is preparing a rough estimate. If they introduce one new product, they are going to diversify into one more business, what will be their profits for the coming 10 years? If they introduce a new product in the market, what will be their impact on the market? So that is, they are estimating for the coming 10 years. That is also a projection. Why? Because that is hypothetical assumption. So they are estimating if we introduce a product, this could happen. That means they might introduce a product, they might not introduce a product. So they are not most likely to happen. It is conditional. Whereas in the case of best estimate, it is most likely to happen. So that we call it as forecast. Whereas if it is purely based on hypothetical assumption, which might happen, which might not happen, that we are going to call it as projection. So these are the two kinds of prospective financial information. One is best estimate and the other one is hypothetical assumption. So we call them as forecast and projection. Most of the people often use it interchangeably. Forecast and projection, in the real market, they often use it interchangeably, but there is a quite difference between the two. Forecast is based on best estimate, whereas projections are based on hypothetical assumption. Clear, everybody? Able to understand regarding this? Okay, so we have understood what are the two kinds of prospective financial information. Now we have to talk about verification. So now, as a practicing chartered accountant, sometimes a client is calling you and asking you to verify their forecast, which is prepared on their best estimate. Sometimes some clients might call you to verify and give an opinion on the prospective financial information, which is purely a hypothetical assumption. The client might come to you with any kind of engagement. He might ask you to verify the forecast, or he might ask you to verify the projection and give an opinion. Then how you are going to do this kind of assignments? How you are going to do this kind of assignments? So we have understood what is prospective financial information. Now let us talk about verification part. So what things we are going to, how we will perform that engagement when a client is approaching us and asking us to do the verification of their prospective financial information and express your opinion on that, how we are going to perform that engagement. So first of all, here most of the things will be similar to whatever discussion we had in the standards. Whatever discussion we had in the standards, according to that only most of the discussion is going to happen here also. So whatever we have seen, engagement, acceptance, understanding the entity, materiality, so all that things, whatever we have seen in normal standards on the auditing, everything more or less is going to get repeated. Here and there a few changes will be there. So now going forward, the standard is going to be very easy. First of all, you need to consider whenever a client is approaching you and asking you to do the verification of their prospective financial information, you have to decide whether you should engage, whether you should accept the engagement or not. You have to decide on engagement acceptance, whether you should accept this audit, whether you should accept this assurance engagement, or you should not accept it. On the basis of what you will decide, on the basis of competence and capabilities. Are you competent enough? Are you capable enough? So you have to keep that factors in mind. So will you be able to comply with the ethical requirements? So like that, there are various factors which you will consider, and then you are going to decide engagement accepted, engagement should be accepted or should not be accepted. So like the way we have seen in SA 220, before accepting the engagement, we are required to consider a few factors. Similarly, before we accept this assurance engagement, when the client is approaching us and asking us to express an opinion on the prospective financial information, we are required to verify a few factors, and accordingly we have to decide whether we should accept the engagement or we should not accept the engagement. So there will be one concept which will be talking about what factors you will consider when deciding whether to accept this engagement or not. Then engagement letter is also required. Yes or no? Yes, we are required to draft our engagement letter, which contains the terms and conditions, what we are required to do, what we are not supposed to do. So what are management responsibilities, what is practitioner's responsibility, what procedures he is going to perform, what is expected from him, how he is going to give the audit report, sorry, assurance report. So all that terms and conditions will be even drafted in the engagement letter. So here also a proper engagement letter will be prepared. So whatever content we have seen in SA 210, some points will get repeated here also. So once we have accepted the engagement, once we have drafted the engagement letter, now we have to actually start our verification work. Now we have to actually start our verification work. So now in the verification, what you have to do, what you have to verify. See, basically, we are not checking whether whatever. So, okay, let me put it this way. See, when I say estimate, when I say management has prepared, when I say management has prepared the prospective financial information, on what basis prospective financial information will be prepared? When I told a client is coming to you and asking you, sir, please verify our prospective financial information. That means client would have already prepared their prospective financial information. So on what basis they would have prepared the prospective financial information? Do you think on the basis of factual data they would have prepared the prospective financial information? 100% no. Prospective financial information will be prepared on the basis of assumptions. On the basis of assumptions. So basically, the complete work in verification of prospective financial information is going to be about checking whatever assumptions which are made by the management, are they reasonable or not? Whatever assumptions which the entity has used in the preparation of the prospective financial information, whether those assumptions are reasonable or not. So like for example, if the management has made an assumption they are going to make a profit of 180 crores in the year 5, I need to decide whether that assumption is reasonable. Is it acceptable here? Here I will say yes, it is acceptable. Why? Because when I see the past trend year after year, the profits of the company are going by 20 crores. Yes, here the management has made a realistic assumption. On the other hand, let us take for example, the management is telling in the year 5 they are going to make 500 crores of profit. What they're projecting in the year 5 they'll make 500 crores of profit. Now you tell me, whatever assumption they have made, is it reasonable? No, it is not reasonable. So like this, the main thing, the most important thing which you are required to verify in this kind of engagement which involves verification of prospective financial information is verifying whatever assumptions which are made by the entity in the process of that preparation of prospective financial information. The assumptions are reasonable, the assumptions are not vague. Number 2, I need to check presentation and disclosure. I need to check what? Presentation and disclosures in that prospective financial information. What I will do, I will try to verify the presentation and disclosure of that prospective financial information. So in the prospective financial information, whether they have given all the disclosures which are required, whether they have explained whatever assumptions they have taken, and I have to make sure that that prospective financial information is not misleading. To make sure that that prospective financial information is not giving a wrong picture, that prospective financial information are okay, they are acceptable. So this is in summary. So basically we have to proceed further with verification. In the material we'll be able to find a long list, but the summary is this. So the main work which we have to do in case if we are doing the verification of prospective financial information is 3 things. We have to check on whatever assumptions the entity has prepared the prospective financial information, is it reasonable, whether that prospective financial information is presented and disclosed in a proper manner, and they are prepared as per proper criteria, and they are not misleading, they are presented fairly. Next, one more thing. So after you are done with all your verification, whatever your findings are there, you are required to report. You are required to express an opinion. Now, one most important thing which you have to pay attention. See, when I am expressing an opinion on the prospective financial information, take for example, the management of Reliance Industries Limited prepared prospective financial information. For the next year, they have prepared a projected balance sheet. In the next year, they have projected a projected P&L. So in the P&L, in the estimated P&L for the coming 1 year, the management of the Reliance Industries Limited is telling they will make a turnover of 10,000 crores. They will make a profit of 200 crores. Sorry, 2,000 crores of profit they are going to make. This is what they're in the prospective financial information. Now, when I'm giving opinion on this prospective financial information, am I giving opinion on that these results will be achieved? If I give, take for example, if I give unmodified opinion, on this prospective financial information, am I giving an opinion that Reliance will be able to achieve 10,000 crores of revenue in the coming 1 year? They will be able to achieve the 2,000 crores of profits. Am I giving assurance on achievability of the results? The answer is no. Your opinion is not about whether that assumptions whatever are stated or whatever things which has been presented in the prospective financial information, whether it will be achieved or not. That is not the opinion, that is not the matter on which you are expressing the opinion. You are expressing the opinion whatever prospective financial information, that you have verified, that is presented properly, in that all the disclosures are there, in that all the assumptions are properly explained, assumptions are properly disclosed. So we are giving our opinion regarding presentation and disclosure of prospective financial information. We are not going to give our opinion on achievability of that prospective financial information. We don't have any duty, we don't have anything to do with achievability, whether that results will be achieved in the future or not. On that we are not giving opinion. We are going to give our opinion regarding presentation and disclosure of the prospective financial information. Able to understand what I'm trying to say? This point is something which you have to maintain the clarity. So this point should be very much clear in your brains. So if we are conducting any engagement as per SAE 3400, where a client is coming to us and calling us and asking us to verify their prospective financial information and express an opinion, yes, we can do that, but we are not at all giving any opinion on the achievability of the prospective financial information. Whatever information that has been stated in the prospective financial statements, that will be achieved. No, that is not the subject matter. That is not on which we are giving opinion. We are in fact giving the opinion whatever prospective financial information is there, whether it is presented properly, whether it is disclosed properly, whether the assumptions are explained properly. We are not going to comment on achievability of the results. Able to understand? Clear? So just we are going to see the presentation requirement. That is what the complete objective when we are doing the engagement of verification of prospective financial information. So this is what the entire structure of the standard. This is what the entire structure of the standard. So tell me, are you able to understand the concept till now? If you understand all this concept, the standard we can read and complete in some 15 to 20 minutes, and the standard will get over. So what we have understood till now, we have understood what is prospective financial information, and we have seen that prospective financial information will be of two types. One is based on best estimate, and the other one is based on hypothetical assumption. Which is prepared on best estimate, we call it as forecast. Which is prepared on best hypothetical assumption, we call it as projection. Then what actually happens in this kind of engagement? First, we'll decide some factors on engagement acceptance, whether to accept this kind of engagements or not. We have to draft our engagement letter. Then we have to start performing our procedures. Actual verification work will happen. In the verification, mainly we are concerned with whether assumptions made by the entity in the preparation of that prospective financial information, is it reasonable or not, whether the prospective financial information is presented and disclosed properly or not, and that prospective financial information should not be misleading. That is what our complete responsibility is. So after we are done with all our verification procedures, then we are required to express our opinion. Then we are required to prepare one report. In that report, we are required to mention some contents. What are that contents which should be there in that assurance report? We will see it in the standard, we'll see it in the material. But one important thing which we have to always pay attention, we are not expressing opinion on whether that future financial information is achievable or not. We are just giving an opinion on whether that future financial information is properly presented and disclosed or not. That's it. So I need a quick yes from you. Are you able to understand the concept till here? Perfect. So thank you for your response. So now, shall we go through the standard now? Yes, we'll not do any further. We'll not do any delay further. So we'll directly jump into the contents of the standard now. So SAE 3400 or SAE 3400, the examination of prospective financial information. So let us try to understand what they're trying to say. First, they are giving a few definitions. What are the definitions? Prospective financial information. Prospective financial information is a financial information which is based on assumptions about events that may occur in future. So it is a financial information which is purely prepared on the basis of assumptions about events that may happen in the future and what will be their possible actions, what they are about to do in the future. On that basis, we are going to prepare the financial information. That only we call it as prospective financial information. It is highly subjective in nature, and its preparation requires the exercise of considerable judgment. It is highly subjective. See, estimates can change from one person to another person. So we cannot assume that two persons will make the assumption in the same way. If one person has prepared an estimate, he will prepare this according to his judgment. If another person is preparing an estimate, he will prepare the estimate as per his judgment. So it is highly subjective in nature, and it is completely dependent on judgment. And prospective financial information can be in the form of either a forecast, or it could be in the form of a projection, or it could be a combination of both also. In some cases, we use both best estimate as well as hypothetical assumption. Sir, what is a forecast, sir? Forecast means prospective financial information prepared on the basis of assumptions as to future event, which management expects to take place. Very important. So here I will mark the important terms here. So in the case of forecast, it will be prepared by the management on the basis of assumptions only, and which management is expecting to take place. Whatever things management is expecting to happen, so that will be taken into consideration. Management expects to take place. And the actions management expects to take as on the date that information is prepared. Whenever that future financial information is prepared, they're preparing it on the basis of actions they want to take. and events that are expected to happen. Best estimate assumption, and in the preparation of forecast, what we use? Best estimate assumption. An assumption that reflects anticipated experience with no provision risk of adverse deviation, which means best estimate assumption means which is most likely to happen. There is a very little risk that this thing is not going to happen. A very little risk will be there. For deviation from this estimate, very little risk will be there. Okay, so an assumption that reflects anticipated experience, expected experience, with no provision for risk of adverse deviation. That means there will not be any major risk that this will not happen. This might not happen, but for that little risk only will be there. For that deviation, little risk only will be there. There will not be a very bigger risk for adverse deviation. So that is what the meaning of best estimate assumption. Example, so they have given some example. In the present market conditions, supply availability, historical buying patterns, and seasonal trends, the CFO of X Limited expects sales to increase by 5% over the next quarter. So on the basis of past data, on the basis of the buying patterns, on the basis of the supply availability, keeping all that past data in mind, the CFO expect that next year sales are going to increase by 5%. It is the best estimate. So this we call it as forecast. Next, projection. Sometimes we prepare prospective financial information in the form of projection also. Now, what is projection? Prospective financial information prepared on the basis of hypothetical assumptions. Hypothetical assumptions means they say in the same line, hypothetical assumptions about future events and management actions which are not necessarily expected to take place. They might not happen. They need not necessarily happen. They might happen, they might not happen. So that is what we call it as hypothetical assumption. Such as when some entities are in a startup phase or are considering a major change in the nature of operations. So basically, mainly projections who will do is startup entities will do. So when they go for funding and all, they take the projections. So they do it completely on the basis of hypothetical assumption. If our product becomes a success, then we will achieve that results. But your product might become a success, might become a failure. We can't say it. Right? That means conditional, you can say. And sometimes a mixture of best estimate and hypothetical assumptions are also followed. Sometimes a combination also will be followed. Now they say a few examples regarding the projections. You can read it by yourself. I have already taken more or less the same examples for the explanation in the beginning, whatever introduction I have given. So I have taken more or less the similar examples. So you can go through these examples later. So I hope you have understood what is the meaning of forecast, what is the meaning of the projection. Now, what is the scope of this standard? When this standard will become applicable? Let us see. Scope of this standard. The purpose of this standard on assurance engagement is to establish standards and provide guidance on engagement, to examine and report on the prospective financial information, including examination procedures for best estimate and also hypothetical assumptions. So why this standard has been given? This standard is given so that the practitioner, like chartered accountants like us, we get some guidance to examine that prospective financial information, and also what examination procedures we have to follow, what verification procedures we have to follow to provide that guidance the standard has been given. Next, now this is a few more important points. They are telling when this standard will not become applicable. Let us see. This SAE, this standard does not apply to examination of prospective financial information expressed in general or narrative terms, such as that found in management discussion analysis. So very important point here. This standard, this SAE 3400 is not going to become applicable in the case of prospective financial information which is expressed in general or narrative terms, which is generally found in management discussion and analysis in an entity's annual report, though many of the procedures here are suitable. See, when I say you are required to verify future financial information, we are required to verify prospective financial information, SAE 3400 will become applicable when that future financial information is in the form of figures. And that future financial information is in the form of figures, in the form of numbers. When you express that future financial information in the form of numbers, like my future profit will be this much, my future revenue will be this much, my future assets will be this much. So when the future financial information is in figures, then SAE will become applicable. See, I have shown you at some point of time annual report. When you open the annual report, I told one of the most important information in the annual report will be MDA, management discussion and analysis will be there. So in that MDA, management will try to say so many things about the company's future. They will say we will become one of the highest, we will become one of the top oil exploring companies in the world in the coming 10 years. That is also talking about the future only. So, but that management has expressed their future in narrative terms, in explanatory terms, in qualitative terms, they have explained the future. They did not express that in the numbers. So in case if you wanted to verify, if you are verifying something which is expressed not in figures, which is expressed in some qualitative terms, like we become top company in the world, we will beat so and so other company, we'll become the leader in the industry. So if this kind of information is getting presented in narrative terms, the future information is presented but in narrative terms, on that SAE will not become applicable. So basically what they are trying to say is this SAE 3400 will become applicable when the prospective financial information is expressed in the form of numbers, in the form of figures. If you are verifying such a prospective information in figures, then SAE will become applicable. At various places, management might say some things about their future in narrative terms, in general terms. If you are verifying such information, then SAE 3400 will have no role to play. Right. So you can write it here in the bracket, only quantitative prospective financial information. Only for quantitative prospective financial information, SAE 3400 will be applicable. Next. Further, the principles laid down in other standards on auditing issued by the Institute of Chartered Accountants of India should be used by the auditor to the extent of practicably in applying this SAE. Nothing but when you are performing this standard, when you are performing any engagement, and when you are required to express your opinion on the prospective financial information, sometimes you are required to follow other standards on audit also. Like as I've told, while engagement acceptance, whatever told in SA 200, you might be required to comply along with SA 200. So in the case of engagement letter, you might be required to comply with SA 210. While deciding materiality, you might be required to comply with SA 320. So when you are called upon to conduct, to review and express your opinion on future financial information along with this SAE 3400, you are required to comply with other standards on audit also. The term auditor is used throughout this SAE. See, in this complete SAE 3400 also, they use the phrase auditor only. You are conducting audit of future financial information, they will say. But just because they are using the term auditor, it doesn't mean that the person whoever has conducted the audit of historical financial information, the same person is also verifying their future financial information. There's no such requirement. They generally use the phrase auditor, the auditor verifying the future financial information. That doesn't mean the person whoever is conducting the audit of historical financial information, the same person should be doing verification of future financial information. There is no such requirement. So what they wanted to say here is auditor can be a different person. The person whoever is conducting audit of historical financial information and giving the audit report, that person can be different, and the person whoever is verifying their prospective financial information, that person can be different. Both the engagements can be done by two different persons. There is no mandatory requirement. Whoever is conducting audit of historical financial information, the same person should do even verification of prospective financial information. There is no such requirement anywhere in the standard. So same thing they clarify here. The term auditor is used throughout this SAE when describing services involving examination of prospective financial information. Such information is not intended to imply that a member performing such services need necessarily be the statutory auditor of the entity's financial statements. There is no such intention. Both can be done by different persons. Okay. So now in this scope, what is important is what they can test you in the form of MCQs. They might not ask a descriptive question here, but the most important thing is this paragraph. They might ask it as a some kind of MCQ. So you have to be very careful about this. Next one. Nature of assurance regarding prospective financial information. So what kind of assurance you are going to give? Here also you are going to give a reasonable assurance. But one thing you have to remember, we are not going to express our opinion on achievability of the results. We are not going to comment on achievability, whether that prospective financial information will be achieved or not. On that, we are not going to give the opinion. We are going to give the opinion whether it is presented properly or not. On that only we are giving opinion. The same thing they try to summarize it here. Prospective financial information relates to events and actions that have not yet occurred and might not occur also. Hypothetical assumption, they may not occur also. While evidence may be available to support the assumptions on which the prospective financial information is based, such evidence is itself generally future oriented and therefore speculative in nature. Even though for the future financial information you get the evidence, but that evidence is highly skeptical in nature, as distinct from evidence which is ordinarily available in audit engagements. Therefore, an opinion as to whether the results shown in the prospective financial information will be achieved cannot be expressed. You cannot express an opinion whether that information, whatever has been stated, whether it will be achieved or not. We can't express the opinion. We can only comment whether that is presented properly or not. We are going to talk on only presentation and disclosure. We are not going to talk upon achievability of the results. We can't say whether that results will be achieved or not. Even we have evidence, that evidence is also speculative in nature, that evidence is also future oriented. So that's why you can't express an opinion whether the results shown in the prospective information will be achieved or will not be achieved. That opinion you can't express it. Somewhere this paragraph has been duplicated, you strike it off. Para number F, you strike it off, that is just a duplication. So that paragraph has been replicated. Next. Yeah. Who is responsible for preparation and presentation of prospective financial information? So in this engagement, the management of the organization, they will prepare the prospective financial information. And as a practicing chartered accountant, as a practitioner, what we are going to do, we are going to verify, right? So that is what they say here. Management is responsible for the preparation and presentation of prospective financial information, including identification and disclosure of the prospective financial information, explaining the basis of the forecast, underlying the assumptions. Everything rests with the management only. They will only identify what kind of prospective financial information they have to prepare, what explanations they have to give, what disclosures they have to give, what assumptions they have to make. Everything will be done by the management. Then as a chartered accountant, what you will do, you will go and verify. You will go and verify. So here there is one reference to the professional ethics. Here there is one reference to the professional ethics. Here we have to do one linking. This SAE 3400 need to be linked with professional ethics chapter. We have to go back to the professional ethics now. In the professional ethics, we have read one misconduct. We have read one misconduct. Which misconduct, sir? We have read something, clause 3 of second schedule. We have read two schedules, right? In that also second schedule, clause 3. If you go to that clause 3 of the second schedule, so let me take you there. So we have to do a little bit of linking here. Listen carefully, important point. You have to be a little careful, important point we are going to discuss here. This is the second schedule. In the second schedule, come to clause 3. So now we have to do a little bit of linking with the professional ethics. Let us see here. If you read clause 3 of part 1 of the second schedule, which says that if you are a chartered accountant in practice, if you permit your name or name of his firm to be used in connection with an estimate of earnings which are contingent upon future transactions in a manner which may lead to the belief that he vouches for the accuracy of the forecast. So clause 3 of part 1 of the second schedule of the professional ethics says that as a chartered accountant in practice, if you are permitting your name or your firm's name to be used with the future financial information, you will be deemed to be guilty of professional misconduct. As a practicing chartered accountant, you are permitting your name or your firm's name to be used along with some future financial information, you will be deemed to be guilty of professional misconduct, which means you should not permit your name to be attached with the prospective financial information. Sir, how come, sir? That is not the complete clause. So that means, sir, if you literally go by this rule, clause 3 is telling if you are a chartered accountant in practice, if you permit your name or the name of your firm with the prospective financial information, then you will be deemed to be guilty of professional misconduct. Oh, if that is the case, then why are we discussing SAE 3400? Then we should not do the assurance engagement only. We should not review the prospective financial information only. We should not do that engagement only. Sir, you are telling SAE 3400, but it is straight away conflict with the clause 3 of part 1 of the second schedule. No, sir. No. Why? Because clause 3 says one more point here. Clause 3 says, which may lead to the belief that he vouches for the accuracy of the forecast. Which means you can permit your name or your firm's name to be used along with the future financial information, but it should not give a wrong picture that you are vouching for the accuracy. That means your usage of the name should not give a opinion, should not give a belief to the reader that, okay, this chartered accountant is giving guarantee that this future will happen. So that kind of engagement you should not do. So summary of clause 3 of part 1 of the second schedule is, as a chartered accountant in practice, if you permit your name or your firm's name to be used along with the future financial information, which is giving a belief that you are vouching for the accuracy, that means you are acting as a guarantee for that future events, then you will be deemed to be guilty of professional misconduct. But if you pay here close attention, in SAE 3400, I have clearly told that you are not at all going to express an opinion regarding the achievability. We are going to just express an opinion on presentation only. So tell me, can you be associated with the assurance engagement? Yes. But you should not give any wrong belief that you are vouching for the accuracy there. That means you are giving a confidence, you are giving a guarantee that whatever future financial information has been presented, that will be 100% achieved. That belief no one should get. till the time that belief you are not giving through your report, you can do such engagement. Okay, that's what only we are doing in SAE 3400 also. In engagement standard, they have clearly told we cannot express opinion on achievability of the results. We are just expressing our opinion on presentation. So that's why you tell me, by doing a comparative study of SAE 3400 and clause 3 or clause 3 of second schedule, clause 3 of part 1 of the second schedule, can I do that assurance engagement? Yes, but you should never give a belief that you are watching for the accuracy of the facts there. Understood? Guys, able to understand this point? Give me one response here. Able to understand this linking? Come on, I need a response from you. Quick. I need a quick response from you. Let us proceed further now. So same thing, they try to elaborate it here. So let me read it quickly. There is nothing much to explain. I have explained already this content. So just we'll quickly go through it. Clause 3 of second schedule to the Chartered Accountants Act 1949 states that a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he permits his name or the name of his firm to be used in connection with an estimate of earnings contingent upon the future transactions in a manner which may lead to the belief that he vouches for the accuracy of the forecast. Same thing we have read there. The above clause does not prohibit a chartered accountant from associating his name with prospective financial statement. That means the above clause is not stopping a chartered accountant from associating his name with prospective financial statements. A chartered accountant can participate in the preparation of profit or financial forecast, and he can also review them, provided that he indicates clearly in his report what are the sources of that information, on what basis that forecast has been prepared, what assumptions were made in arriving at that forecast, so long as he does not vouch for the accuracy. So that means you can get associated either in the preparation of future financial information or in the review of future financial information to the extent you are not creating any belief to the reader that you are vouching for the accuracy. So in the report, you are just telling what are the sources for the information, on what basis that forecasts are prepared, whatever assumptions that are used. If you are just telling that, you are not giving any guarantee for the achievability of the results, you can continue to accept such engagements. Professional ethics is not going to stop you. The same also applies to projections made on the basis of hypothetical assumptions about future events and management actions, which are not necessarily expected to take place, so long as vouching for the accuracy of the projection is not made. So long you are not giving guarantee for that achievability, you can continue to associate your name with the future financial information. There is no such restriction. Okay, so till now everybody able to understand here, right? So what we have seen in the standard, we have seen few definitions, we have seen what is the scope of the standard, what kind of assurance you are going to give, and what will be the who is responsible for preparation and presentation of prospective financial information, and whether a chartered accountant can do this engagement or not. Now let us talk about duties of the member, whoever is examining that prospective financial information. So if I am a chartered accountant in practice, if I was called upon by some entity, they are asking me, sir, we have prepared the prospective financial information, you please come and verify. If they ask me what are the responsibilities, what I am supposed to do, let us see. In an engagement to examine prospective financial information, the auditor should obtain sufficient appropriate audit evidence. Here also you need to obtain the evidence as to whether management's best estimate assumptions on which prospective financial information is prepared are not unreasonable. Nothing but basically whatever best estimate assumptions whatever management has made, are they reasonable, and whatever hypothetical assumptions they have made, whether such assumptions are consistent with the purpose. For whatever purpose they are making that hypothetical assumptions, they are making proper hypothetical assumptions or not. So basically, if I have to say summary, whether assumptions are reasonable, if I have to wind up in single line, I have to check. The main responsibility of me is I have to verify whether assumptions are reasonable, best estimate assumptions are reasonable, and hypothetical assumptions are consistent with whatever purpose these financial statements are getting prepared. Next, second one, the prospective financial information is properly prepared on the basis of assumptions. So first one, they're talking about verify the assumptions, whether they're reasonable or not. Number two, we have to check whether they are properly prepared or not. And the prospective financial information is properly presented and all material assumptions are adequately disclosed, including a clear indication as to whether they are best estimate or hypothetical assumptions. And I need to check that the management, while preparing that prospective financial information, in that prospective financial statements, they should have clearly disclosed what assumptions they have made, and also they have to explain whether those assumptions are best estimate assumptions or hypothetical assumptions, where they have to give the disclosure. In that prospective financial information only they have to give that disclosure. And the prospective financial information is prepared on a consistent basis with the historical financial statements using appropriate accounting policy. On whatever basis historical financial information you have prepared, whatever accounting policies that are followed in the historical financial information, on the same lines even you are required to prepare prospective financial information or also. Who management, whether they have done that or not, that I need to verify. Like if they're following certain method of depreciation in historical financial information, the same method of depreciation should have been followed even in the prospective financial information also. So I need to check consistency with historical financial information. So as you could see here, whatever I have told you in the summary, my duties are just verifying whatever assumptions they have made, whether those assumptions are reasonable or not. I need to verify whether they're properly prepared or not. I need to verify whether they're properly disclosed and presented and all things are explained or not. And I need to check whether they are consistent with historical financial information also. Whatever accounting policies which are followed in the historical financial information, the same policies are followed in the prospective financial information as well. So while examining prospective financial information, principles laid down in other standards on auditing also should be applied. So as I've told, along with this SAE, if there are any other standards on auditing will come into picture, you have to comply with that also. So they might ask you a question, what are the duties of the auditor who is examining prospective financial information? Then you are required to write this simple 4 points. Let me write the summary for you. Let me write the summary, or you also write along with me the summary here. First point, assumptions are reasonable. Write it along with me. You need to comment. First thing, you have to verify whether assumptions are reasonable. Number 2, they are properly prepared. Properly prepared. That is the second point. Third point, properly disclosed. Third point is properly disclosed. Fourth point is consistency with historical financial information. That's it. Clear? So this is what regarding duties of the member, whoever is examining that prospective financial information. Simple 4 steps. Next, coming to the G point. So engagement acceptance. As I've told, first you have to decide whether you can accept the engagement or not. So precautions to be taken by an auditor before accepting in such an engagement. So when a client has come to you and asked you to do the verification of their prospective financial information, whether you should accept that engagement or you should not accept that engagement, what factors you will try to keep in mind. So before accepting an engagement to examine the prospective financial information, the auditor would consider, among other things, intended use. What is the purpose? Why this prospective financial information is getting prepared? You have to understand that. Whether the information will be general or limited distribution, whether this information will be circulated to everybody or this information will be distributed only to a limited number of people. And what nature of assumptions? What assumptions are using? Are they using best estimate assumptions or hypothetical assumptions? And also, what elements will be included in the information? In that prospective financial information, what elements will be there? Will they prepare only P&L? Will they prepare only balance sheet? Will they prepare cash flow statement also? So what elements will be included? That also you have to keep in mind. And what is the period covered by the information? How long they are preparing? For example, if they are telling for the coming 30 years, we will make an estimate. I will not accept such engagement. Why? Because 30 years, who will know what will happen? If they're coming to me with an assumption for 1 to 5 years, okay, I can accept it. But if they prepare prospective financial information for coming 30 years, 40 years, I will simply say no. Why? Because that is very unrealistic. So these are the factors which should be kept in mind as an auditor, as a practicing chartered accountant, when a client has approached you and asking you to do the verification of prospective financial information. So 5 factors they have told. Number 1, you have to find out what is the intended use. You have to understand about distribution, to whom it will be circulated. What is the nature of assumptions they are using? Are they using best estimate or are they making hypothetical assumptions? What are the elements which will be included? And along with that, what will be the period covered by that prospective financial information? Next one. Further, the auditor should not accept or should withdraw from the engagement when the assumptions are clearly unrealistic. When you felt that whatever assumptions management has made clearly unrealistic, so many unrealistic assumptions they have made. Last year profit was 100 crores. In the current year, they are estimating they will make 1000 crores of profits. Completely unrealistic. Don't accept. Or after accepting, if you came to know, withdraw. When the auditor believes that prospective financial information will be inappropriate for its intended use, or if you feel that the prospective financial information is completely inappropriate, it will not serve the purpose, then also don't accept it. So 2 cases where you should not either accept, or if you have already accepted, you have to withdraw. When you came to know that assumptions are completely unrealistic, and when the prospective financial information is not suitable for its intended use. Next, the auditor should consider the extent to which reliance on the historical financial information is justified. Like in other engagements, it is necessary that the terms of engagement should be agreed with the client by sending an engagement letter. Nothing but you have to draft your engagement letter as well. As a student, engagement letter also you have to draft it. Now talking about examination procedures, what procedures you are going to perform. When determining nature, timing and extent of examination procedures, that means how much in-depth audit procedures you have to perform, what type of procedures you have to perform, how many number of transactions you have to verify. So the nature, timing and extent of audit procedure. Should I perform more procedures or less procedures? This the practicing chartered accountant has to decide. Keeping what factors in mind he will decide? Let us see. When determining nature, timing, and extent of examination procedures, the following matters should be considered. Should you perform more procedures or less procedures? That depends on the following factors. Number one, the knowledge obtained during any previous engagement. If you have done any past engagement for the same client, you can use that information and accordingly you will decide. Management's competence regarding the preparation of prospective financial information. How much management is competent? Are they capable person or are they incapable persons? If the management are not that capable, without that capacity only they have prepared the prospective financial information, I will try to spend more procedures. Likelihood of material misstatement, nothing but this only we call it as risk of material misstatement. If the risk is very high, more procedures. If the risk is low, less procedures. The extent to which the prospective financial information is affected by management judgment, nothing but how much judgment is involved. Higher the judgment involved, higher the risk. Higher the risk, more procedures. Lower the judgment involved, lower the risk. Lower the risk, lower the procedures. So even you need to understand to what extent the prospective financial information is affected by management's judgment. What are the sources of the information? On the basis of what sources they have prepared that prospective financial information? The sources of information considered by the management for the purpose, their adequacy, their reliability of underlying data, data derived from third parties, industry statistics to support the assumptions. So what source they have used in the preparation? The stability of entity's business, whether the entity is stable or not stable. For example, if the entity's business is very much stable, then there will be less risk associated with the future financial information. When the company's business is not so stable, last year they have made 100 crores of profit, but the business is not good, business is not stable, industry is weakening, then even though they have made a realistic assumption of 120 crores, they have high chances of going it wrong. In these cases, I have to perform more audit procedures. You have to pay more attention to stability of the entity's business also. And even you need to consider what is your engagement team's experience with the business and the industry in which you are operating. So nothing but you have to pay attention to engagement team's experience also. So all these factors the person has to consider in determining nature, timing, and extent of procedures. So as you could see, there is nothing much new here. All these are general points. You can prepare one short summary of all these points. So number one, what you should do. So what are the factors you are required to consider? So I'm writing it for the sake of your quick revision. So first one, you can use knowledge, past knowledge you can use. Past knowledge you can use for the purpose of performing, deciding on nature, timing, and extent of audit procedures. Number two, you have to check management competence, management capabilities. Number three, risk of material misstatement. Number four, judgment of management. Judgment of management. Then what are the sources of information? From which sources you are going to get the information? Then we have to see stability of the business. And then finally, engagement team's experience. These are the factors which our accountant will keep in mind and accordingly decide nature, timing, and extent of the procedures. Next, something else they try to say here. Let us see what are they. In performing these procedures, source and reliability of the evidence supporting management's best estimate assumptions needs to be assessed. So after performing these procedures, you will get the evidence. You will check whether that evidence are realistic or not. You need to analyze that as evidence. Nothing but you have to, after performing the procedures, whatever evidence you get, that evidence you have to analyze whether that evidence is sufficient and appropriate or not. Such evidence may be available from varied sources like entities' budgets, debt agreements, industry publications. You can get all that evidence to support the assumptions from various sources. On the basis of budgets, you can cross-verify the assumptions with the budgets. You can cross-verify the assumptions with the loan agreements. You can also cross-verify that assumptions with the industry publications also. So this you have to do in the case of best estimate assumptions. In the case of hypothetical assumptions, you need to check all significant implications of such assumptions should have been taken into consideration. Which means I will give you example. See, when they have made a hypothetical assumption, see, they have taken loan, and they're preparing a prospective financial information. If they have, they have not yet taken the loan, they're looking for loan. So banker asked them to prepare prospective financial information on the basis of hypothetical assumption for the coming 10 years. In case if the bank has given the loan, how they are going to use it. The bank is telling that, okay, if you give us the loan, we will invest. So that means in the coming 10 years, they have increased their plant and machinery. The plant and machinery for the coming 10 years has been increased, has been inflated. Why? Because they made an assumption that from that loan, they are going to invest in the plant and machinery. See, when they have invested in the plant and machinery, the depreciation also should have increased. Depreciation should also have been increased. Why? Because when you buy the plant and machinery in the prospective financial information, depreciation also should have gone up. So like this, in the case of hypothetical assumptions, all the interconnected things are properly reflected or not. That also you need to check it. Why? Because one assumption will have an impact on the other. Clear, everybody? So like that, in the case of hypothetical assumptions, you need to check all significant implications of such assumptions should have been taken into consideration. Next, it needs to be verified that hypothetical assumptions are consistent with the purpose of prospective financial information, and there is no reason to believe that they are clearly unrealistic. Even you have to check the reality of the hypothetical assumptions also. So this is what regarding the things which you have to keep in mind regarding nature, timing, and extent of the procedures. So as you could see, nothing new here. Everything is very simple. In that, the most important thing is this first point. They might ask you a question: what are the factors which auditor should consider in determining nature, timing, and extent of procedures regarding prospective financial information? So then you are required to write that 6 points, whatever summary I have written it for you. Next, you need to check presentation and disclosure. Let us see what they're trying to say regarding presentation and disclosure. When assessing the presentation and disclosure of the prospective financial information and the underlying assumption, in addition to the specific requirements of any relevant statutes, regulations, as well as relevant professional pronouncements, it need to be considered. Particularly when you are verifying the presentation and disclosure requirements, you need to consider the following information. What are they? As a practitioner, you need to concentrate on the below things when you are checking the presentation and disclosure. What things I have to concentrate? The presentation of prospective information is informative and not misleading. Whatever prospective financial information is there, that has been presented in an informative manner. It is not presented in a misleading manner. The accounting policies are clearly disclosed. Whatever accounting policies they have followed in the preparation of that prospective financial information, they should have clearly disclosed it. Whatever assumptions they have used in the preparation of that prospective financial information, that assumptions also should be disclosed. The assumptions are adequately disclosed in the notes to prospective financial information. It needs to be clear whether assumptions represents management best estimate or hypothetical. And when assumptions are made in areas that are material and are subject to a high degree of uncertainty, this uncertainty and the resulting sensitivity also should be disclosed. Nothing but the summary of this is you need to check whatever assumptions the management has made in the preparation of that prospective financial information. All that assumptions are clearly explained. Along with that, the nature of that assumptions, are they best estimate, are they hypothetical, that also should be explained. And if that assumptions involve high degree of uncertainty, that uncertainty also should be explained. And the date as of which the prospective financial information was prepared is disclosed. On what date you have prepared that prospective financial information, that date is also required to be mentioned. Management needs to confirm that the assumptions are appropriate as of this date, even though the underlying information may have been accumulated over a period of time. Nothing but whatever assumption management has made and whatever date they are preparing this prospective financial information, on the date of preparation of prospective financial information, whether those assumptions are reliable or not, that also they have to state it. And the basis of establishing points in a range is clearly indicated, and the range is not selected in a biased or a misleading manner when results are shown in terms of range. See, prospective financial information can be either shown as point basis or range basis. So this we have come across in SA 540 also. We can do either a point estimate or we can do a range estimate. So what do you mean by point estimate? What do you mean by range estimate? Like for example, management is going through last few years of profits. Year 1, 50 crores. Year 2, 65 crores. Year 3, 75 crores. This is the profits of the last 3 years. Now, on the basis of the past data, they might make an estimate that in the next year, in the year 4, the profit is going to be somewhere around 85 crores. This is point estimate. Sometimes management might say that in the year 4, the revenue could be somewhere around 80 to 90 crores. This is what a range estimate. So the prospective financial information can be either a point estimate or even it could be in a range estimate. In case if the management is preparing the prospective financial information in the form of a range, we need to check whether this range is reasonable or not. See, 80 to 90 is a reasonable range. The management cannot say year 4 profit could be somewhere around 60 to 160. So that much wide range should not be there. Within a reasonable range, the information should have been given. In case if the management is preparing the estimates on the basis of a range, they have two options. Either they can do point estimate or they can do a range estimate. Next one. If there is any change in the accounting policy of the entity from that disclosed in the most recent financial statements, whether reason for that change and the effect of such change on the prospective financial information has been adequately disclosed. Nothing but change in accounting policy. Like for example, recent historical financial information. Financial year 23-24 got over. For this year, historical financial statements are prepared. In that historical financial statements, they will give notes to accounts. In that notes to accounts, they have explained the accounting policy. In that accounting policy, they told that they have followed SLM method of depreciation. But in the prospective financial information, now they prepared prospective financial statements for the year 24-25. In the prospective financial information, what they have done is instead of charging depreciation on SLM method, they have charged the depreciation on WDV method. Now, in that prospective financial information, they have to explain the reason why they have changed the accounting policy when compared with the latest recent historical financial information, and what are the reasons for that, that also they have to explain. So if there is any change in the accounting policy of an entity from that disclosed in the most recent historical financial statements, where reasons for the change and the effect of the change on prospective information has been adequately disclosed or not. So this is also important point. They might ask you a question: what are the responsibilities of the auditor when verifying presentation and disclosure of prospective financial information? So what you're supposed to write: 6 simple points. Number 1, presentation should not be misleading. Number 2, accounting policy should be disclosed. Number 3, assumptions should be disclosed. Number 4, date on which that prospective financial statements are prepared, that should be disclosed. Number 5, in case if it is a range, the proper range should be disclosed. Range should be proper. Number 6, if there is any change in the accounting policy from the recent historical financial information, even that range is also required to be disclosed. Understood, everybody? Clear and comfortable? So this is what regarding presentation and disclosure. This is also having a high chance of getting tested. Now, okay, after we are done with all the procedures, after we have verified everything, now we will have some findings. On the basis of that findings, we are required to prepare a report. Let us see what information should be presented in that report. First, there should be title. When you are done with the verification of prospective financial information, you are required to prepare a report. In that report, the first content should be title. Proper heading should be there. A proper heading should be given. Number 2, there should be addressee. Proper addressee should be there. To whom you are expressing your opinion, that addressee also should be there. Identification of prospective financial information. You have to explain what is included in the prospective financial information. Like it includes projected balance sheet, projected P&L, projected cash flow statement. So you have to identify that prospective financial information. Reference to standards on auditing applicable to the examination of prospective financial information. While verifying that prospective financial information, in case if any standards on audit you followed, even you have to give the reference to that standards on audit which you have followed in the assurance engagement. And also you have to state that management is responsible. You have to clearly mention in your report, management is responsible for the prospective financial information. And when applicable, a reference to the purpose and or restricted distribution of prospective financial information. Even you have to explain for what purpose this prospective financial information is prepared, and it will be distributed to whom. To whom it will be distributed? It will be distributed to everybody, or is the distribution restricted? That distribution also you have to comment on. Statement that examination procedures included examination on a test basis, that is on a sampling basis of evidence supporting the assumption, amounts and other disclosures. So you have to say that what procedures you have followed in order to get the evidence regarding assumption, amounts and disclosures. What procedures you have followed, that also you have to explain. Statement of negative assurance as to whether assumption provides a reasonable basis for the conclusion. So you have to give a assurance, that too in a negative form you have to give the assurance. Sir, what do you mean by negative assurance? That means whatever terminology we have used in the SRE, in the case of review engagements, we issue our conclusion in a negative terms. That means based on a review, nothing has come to our knowledge that financial statements are misleading. Do you remember? In the case of audit, we give positive opinion. In the case of audit, while I was explaining the difference between audit versus review, one point of difference was in the audit, if we are satisfied with everything, we will say that in our opinion paragraph, financial statements give a true and fair view. We say it in positive terms. Whereas in the case of review, we say based on a review, nothing has come to our attention which make us believe that financial statements are not prepared as per applicable financial reporting framework. Both are trying to say same thing. One, in audit, we say financial statements give true and fair view. Whereas in the review, we say the same thing in a negative way. We say nothing has come to our knowledge which makes us believe that financial statements are not giving true and fair view. Both are trying to convey same thing. But in audit, we give positive wording. In review, we give negative wording. Same negative wording, you should use it even in the case of assurance also. When you are giving a report on prospective financial information, you have to give your assurance in negative terms. How you have to give negative terms? We have to say, on the basis of procedures, whatever we have performed, nothing has come to our attention which makes us believe that this prospective financial information is misleading. You are trying to say positive thing only, but terminology which you have to use it is negative phrases. So you have to say, if you are satisfied with everything, you should say, based on our procedures, nothing has come to our attention which make us believe that assumptions are unreasonable, which make us believe that the financial statements are this prospective financial information is not presented properly. No such information has come to our notice. That means you are ultimately telling prospective financial information is not misleading only, but you are trying to say it in a negative way. So we use that negative phrases in the case of review engagement. The same kind of negative phrases we are going to use it in the case of assurance engagements also. Clear, everybody? So this is what you are required to remember. You have to give a negative assurance. Whatever assurance you want to express in negative terms, you have to express it. Nothing has come to our knowledge which makes us believe that assumptions are unreasonable. You should not say we believe that assumptions are all reasonable. You should not say in this positive way. You should say nothing has come to our attention which makes us believe that assumptions are unreasonable. Ultimately, you are telling assumptions are reasonable only, but you are trying to put it in negative way. So that kind of terminology you have to use it. Next, after that, you have to explain opinion as to whether prospective information is properly presented on the basis of assumptions and is prepared in accordance with relevant financial reporting framework. Appropriate caveats, nothing but warning. Appropriate warnings concerning the achievability. If you find any warnings, the management has made the assumptions, but you are finding that there are some warnings that this will not be achieved. That warnings, if you find any, that also you are required to indicate it. And also you have to mention the date of the report, at which place you are signing, and your signature also you have to affix it. So all these are the contents of the report as per SAE 3400. Just you have to give a reading once and ignore it. Just read it once, read all the content once and ignore it. Next, such a report would state, in that report you have to mention certain things, what you have to state in your report. State whether, based on the examination of the evidence supporting the assumptions, anything has come to attention which causes the belief that assumptions do not provide a reasonable basis for the prospective financial information. Same thing as I've told, you have to comment that on the basis of whatever procedures you have performed, did anything come to your notice which makes you believe that assumptions are not reasonable? That means, did you find anything which makes you believe that assumptions are unrealistic? That you have to comment. And you have to express an opinion as to whether prospective financial information is properly prepared on the basis of assumptions and it is prepared in accordance with relevant financial reporting framework. You have to express your opinion whether the assumptions are reasonable and whether it is prepared in accordance with applicable financial reporting framework. And particularly, you have to state that actual results are likely to be different from the prospective financial information, since anticipated results frequently do not occur as expected and the variation could be material. You should also clearly give a line in your opinion, in your report, that we are commenting on this prospective financial information. Whatever actual results are there, that could be quite different from this prospective financial information. That line also you have add. That means you are clearly telling you are not vouching for accuracy. If you add this line, that actual results might be quite different from whatever prospective financial information you have given, that means you are trying to educate the reader that you are not vouching for the accuracy of the facts. So that line also you have to add. Likewise, when the prospective financial information is expressed as a range, it would be stated that there can be no assurance that actual results will fall in the range. In case you are giving the prospective financial information in the range, should also add a line that there is no guarantee that actual information will fall within that range. Next. In the case of a projection, the prospective financial information has been prepared for using a set of assumptions that include hypothetical assumptions about future events and management's actions that are not necessarily expected to take place. Add this line also. In case if you are verifying projection, you have to clearly say these prospective financial information is prepared on the basis of hypothetical assumptions. They might occur, they might not occur. That also you give the clarity. Next, consequently, readers are cautioned that the prospective financial information should not be used for the purpose other than above mentioned intended use. We should also clearly say what is the purpose of this prospective information, and also say that this information should not be used other than for intended purposes. Next, when it is believed that presentation and disclosure of the prospective information is not adequate, after performing all the procedures, you came to know that the presentation and you have obtained evidence that the prospective financial information is not presented or disclosed in a proper manner, then you have to give either a qualified opinion or adverse opinion on the prospective financial information, or if you consider it necessary, you have to withdraw from the engagement. When you came to know after performing all the procedures, presentation and disclosure is not proper, either you have to withdraw from the engagement or you have to give either qualified or adverse opinion. Next one. When it is believed that one or more significant assumptions do not provide a reasonable basis, that means in case if you came to know that assumptions are unreasonable, whatever assumptions management has made in the preparation of that prospective financial information, if assumptions are unreasonable, the standard says for the prospective financial information on the basis of hypothetical assumptions or on the basis of best estimate, you have to directly give adverse opinion, setting out the reasons in the report, or you should withdraw from the engagement. If there is a problem with presentation and disclosure, then the standard has given you permission to either use qualified or adverse. But in case if there is a problem with the assumption only, the standard is not giving you option of qualified. It is asking you to go to extreme and directly give the adverse opinion. If there is a problem with the assumption, if the assumptions are only wrong, no chance of qualification, directly give adverse. If there is a little bit of problem with presentation and disclosure, then you can decide whether that is material or material and pervasive. If it is material and pervasive, if it is material but not pervasive, give qualified. If it is material and also pervasive, give adverse. But when there is a problem with the assumption only, with assumptions are only wrong, then what you should do? Directly adverse. However, in case if you are unable to perform some procedures, when the examination is affected by conditions that preclude one or more procedures, if you are unable to perform the audit procedures, then what you should do? You have to either withdraw from the engagement or give a disclaimer of opinion. Don't we know that? We all know this. So, but here also, this also they can twist you in MCQs. Let me give you here summary. Reporting. Okay. Modified opinion. Copy it along with me. This they might test you in the form of MCQs. They will confuse you. So that's why I will prepare a summary better. Modified opinion in case of prospective financial information as per SAE 3400. So here they give, I'm talking about three cases. Talk about three cases. Number one, presentation and disclosure is improper. Here the options are either withdraw, or you can give either qualified or adverse. The presentation and disclosure is not proper, but the effect of that misstatement is only material but not pervasive, give qualified. If it is material and also pervasive, give adverse. Whereas if there is a problem with assumptions, if assumptions are only unreasonable, here also, first, if possible, withdraw. Don't do the engagement, withdraw. Or if you are not permitted to withdraw, then what you do is directly give adverse. Here there is no choice of qualified opinion. Here you should not decide what is the effect. Effect is material or material and also pervasive. Effect you should not see here. Directly adverse. Why? Because assumptions are only wrong. So that's why here standard did not give you a free hand. There is no option to choose a qualified opinion. Directly give adverse if there is problem with assumption. In case if you are unable to perform procedures, then also what you should do, then also standard is telling here, do one thing, if possible withdraw. Sometimes withdrawal will not be possible, then you give directly disclaimer. Here also qualified option is not there. Here directly you have to give disclaimer of opinion. So they can play with you when it comes to MCQs regarding this matter. So better you copy this or take a screenshot, whatever you want, you do it. But here they can play with you in the MCQs. So that's why better you write it somewhere. Done? Let me know when you are done. Okay, perfect. I got the reply that it is done. Okay, so let me proceed further. Documentation. So finally, you are required to maintain some documentation also. What matters you are required to document? So documentation matters which are important in providing evidence to support the report on examination of prospective financial information, and evidence that such examination was carried out in accordance with this SAE should be documented. So whatever matter you feel that will act as evidence for the prospective, whatever report you have given, whatever matter you feel that will act as evidence for this report, and also whatever evidence that whatever document that will give you evidence that you have conducted the engagement as per this SAE, everything should be documented. So even you have to comply with the documentation requirements also. So that's it. We are done with SAE 3400. I hope you guys are able to understand this. So what and all we have covered? What and all we have covered in the standard? So first we understood what is the meaning of prospective financial information, and we have seen what are the different types of prospective financial information. Prospective financial information can be divided into two categories. One is forecast, other one is judgment. So then we have understood what is the scope of the standard, when the standard will become applicable, when the standard will not become applicable. So basically, when you are when the future financial information is expressed in narrative terms or general terms, then the standard will not have any role to play. Next, what kind of assurance you are going to give? You are going to give reasonable assurance, but you are not able, but you cannot express the opinion on achievability of the results. You are just going to comment on presentation and disclosure requirements. Next, it is whose responsibility to prepare prospective financial information? It is completely responsibility of the management. But here there will be a mismatch with the clause 3 of part 1 of the second schedule. No, there is no mismatch. Why? Because clause 3 of the part 1 of the second schedule prohibits a chartered accountant deems a chartered accountant to be guilty of professional misconduct only when he is vouching for the accuracy. But in the assurance engagement, we are not vouching for any accuracy. We are just commenting whether that prospective financial information is presented and disclosed properly or not. Then after that, what are the duties of the member while examining the prospective financial information? Simply four duties. You have to check whether assumptions are reasonable or not, whether that prospective financial information is properly presented or not, whether it is properly disclosing all the assumptions or not, whether it is consistent with the historical financial information. Then acceptance engagement. What factors you have to keep in mind in deciding whether you can accept the engagement or not? Number one, intended use. What about its distribution? What are the nature of assumptions? What elements are included and what period will be covered? And in case if you find that assumptions are unrealistic and prospective information will be inappropriate, you have to withdraw from the engagement. And you need to get all the terms and conditions drafted in the engagement letter. Then what procedures you are going to what factors you will decide nature, timing and extent of audit procedures on the basis of knowledge obtained during previous engagement, management's competence, likelihood of the material misstatement, nothing but risk of material misstatement, judgment of the management, sources of the information, and stability and experience. So the most important questions from this standard are this examination procedure. What are the nature, timing and extent of the examination procedures? So that is one important question. And the other one, acceptance of the engagement. This is also important part. Acceptance of the engagement, when you should accept, when you should not accept, what factors you will consider. That is also one important part. From there also a question will come. Presentation and disclosure. This is also important part. We need to check presentation and disclosure. 6 things we have to specifically check: that information is not misleading, accounting policies are disclosed, assumptions are disclosed, date of presentation of prospective financial information, in case if it is a range, whether that range is proper or not, if there is any change in accounting policy, the reasons for the change in accounting policy also should be disclosed. Then you have to give a report. In the report, everything is a general point. You need not worry about it. One important thing we have to keep in mind is opinion will be expressed in negative terms. Nothing has come to our knowledge which makes us believe that assumptions are not reasonable. So like that, negative wording you have to use. And then finally, the most important thing here is what things must be compulsorily included in the report. And along with that, when you are going to give the modified opinion. So when it comes to modified opinion, this chart is something which is very important. When there's a problem with presentation and disclosure, either you can withdraw or you can give qualified or adverse. When the assumptions are unreasonable, directly adverse, or you can withdraw. When you are unable to perform procedures, here also option to withdraw will be given. In case if you are unable to withdraw, then you are required to give the report which contains a disclaimer of opinion. Okay, and then finally, documentation also you are required to maintain matters which are important in providing evidence and matters which give you conclusion, which give you confidence that it is carried out in accordance with the standards on this assurance engagement, or everything should be documented. Clear everybody? Right. So with this we are done with SAE 3400.